Let's quickly recap what happened in 2022.
Russia's shutting down gas supply.
Rising inflationary pressures across the economies, driven predominantly by supply chain constraints and the rising input costs, particularly in terms of oil and gas, has forced the central banks to take measures in terms of increasing their benchmark interest rates. As the result of this, indirectly,
this is the correction that we've all been talking about for years.
Total money invested falling to a 9-quarter low.
Funding conditions are going to be very tight.
Hi, my name is Manpreet Ratia. I'm a managing partner with Jungle Ventures. And it's a pleasure to be speaking to you guys again today. Tough year from a funding perspective. Funding did happen. Funding was taking place. But I think what the people were looking for was more in terms of path to profitability, looking at things like burn rates, and decisions were getting longer or were taking longer than in the past. Everyone was looking at, is there profits? If not, is there a verifiable or is there a model or is there a trustworthy way of demonstrating a path to profitability? Number two is the valuations were getting significantly stressed. So the expectations in terms of runaway valuations, expectations around round sizes, etc., had to be muted. So the companies were able to raise money, but not at the valuations which they were able to do previously, and also not the same amount of capital which they were able to raise. So for all you guys in the startup world, if you think that this year, the emphasis in terms of growth is going to come back, I suspect that's not going to happen. I think the emphasis in terms of demonstrating sustainable performance, growth over quarters, efficient use of capital, a significant control in terms of your ability to control your expenses is going to be very important for you. We were hoping the markets would come back by the end of last year, but we still think that is still too far out. Is there capital still available? Both in the private markets in terms of VC and private equity? Absolutely. There's a significant amount of dry powder which is still available for us. Simplistically put, I think the way I'm looking at it is the time horizon for underwriting has changed. So if earlier, VCs could look at it by saying that, okay, I see a roadmap to profitability, let's say 10 years or 8 years down the line, and I'm happy to underwrite that. But I think the time horizon out here has got significantly shrunk. People are now looking at a roadmap to profitability, which is, if not now, is at least 2 or 3 years down the line. So that compression in terms of what is your underwriting criteria, particularly in terms of your time horizon, has shrunk considerably. Continue to maintain an absolutely tight control over your operations, demonstrate a significant progress towards your profitability. If you do have access to capital or you have capital which is out there, explore, be opportunistic, look at M&A activities defined as entry into new markets, defined as probably taking out a competition and therefore making it easier from you and giving you certain pricing luxury. So those are the things which I would encourage you to do. And the third thing is, guys, the race for capital is going to continue. It is going to take longer. Be more patient. Be out there in the market. Keep talking to people. You don't have to necessarily be fundraising. There is a bunch of capital lying out there which could be of interest to you. Reach out to them. Tell them about what you're thinking in terms of their business. Seek their inputs in terms of what they think about your business, so you're able to correct it, rather than go out to these guys and seek their inputs or seek their advice, or to pitch to them only when you're raising capital. So that's what I would encourage each and every founder to continue to do.